So we have this question here. It says Xplc is considering an investment in a new yogurt making machine costing 1.8 million with a useful life of 4 years. The expected annual production and sales volume is 250,000 units of yogurt. The per unit details are here. Selling price 10 kwacha per unit, material cost 4 kwacha per unit, variable overhead cost per unit 2 kwacha per unit. Annual fixed costs, rent, salaries are 120,000 and are not expected to increase over the project life. The machine is expected to have a scrap value of 60,000 at the end of year 4. Inflation is expected to apply from year 2 onwards as follows. Selling price 9% per year, variable costs, materials plus overhead 10% per year. The company's minimum required rate of return is 11% per annum and corporate tax is 30% per year. So the question is required, evaluate whether the company should accept the project using the net present value method. Then evaluate whether the company should accept the project using the internal rate of return method. Right. So colleagues, remember the steps are usually the same for this type of questions. Step 1, we need to make adjustments for the selling price and variable costs.
My twin sister account number on my twin sister red heart. 2 hearts. Face with heart-shaped eyes.
All right. Yes. So year 1 selling price is going to be 10 kwacha. Year 2 is going to increase by 9%. All right. So we're going to say 10 kwacha multiplied by, remember our growth factor here is 1 plus R. Okay. R is the rate, inflation rate, which is 9%. I'm going to say 10% multiplied by 1.09. All right. This 0.09 is just this 9%. All right. Yes. So 10% multiplied by 1.09, that's going to be 10.9 kwacha. This is the selling price for year 2. Year 3, this 10 kwacha 19 kwe is going to grow by another 9%. So we're going to say 10.9 multiplied by 1.09, we get 11.88. That is the selling price for year 2. Okay, year 4. Wait. So that was year 3. Year 3, 10.9 multiplied by 1.09. We're just saying that this 10.9 kwacha is growing by 9%. So 10 times 1.09, that's 11.88. Yes. Okay. Okay, right now we're under step 1. We're making adjustments for the selling price first. Okay. Remember, yes. Remember the selling price is increasing by 9%. Okay. Yes. So we have found the selling prices. We are now on year 4. Okay. Year 4, the selling price for year 3, 11.88 multiplied by 1.09. This 1.09 just represents a 9% increment. Okay, so 11.88 multiplied by 1.09, 12 kwacha, 95 ngwe. That is the selling price for year 4. I hope we're all clear with this. Any questions? All right, now we go to the selling price for, the variable costs. Okay, variable costs. First, we total them up. Okay, the materials plus, because remember the variable costs are here, material cost per unit and variable overhead cost per unit. So we're just adding them up. All right. If you want, you can solve them separately, but in an exam, that would be it will take more time. So just combine them. Okay. Yes. So variable costs, 4 kwacha plus 2 kwacha, that is 6 kwacha. That is the variable cost, total variable cost. Now we start. So in year 1, it will stay as 6 kwacha. Year 2, we've said the variable costs are increasing by, 10% per year. All right. So 1 plus R equals 1 plus 10% in decimal is 0.1. So our growth factor is 1.1 here. Let me also just put it here for this other thing for study purposes. Okay, so our growth factor is 1.1. All right, so in year 1, variable costs are 6 kwacha. Year 2, we're going to say 6 multiplied by 1.1. That gives us 6.6. That is the variable cost for year 2. Year 3, okay, 6.6 multiplied by 1.1. That gives us 7.26. Year 4, 7.26 multiplied by 1.1, 7.99. Those are the variable costs from year 1 to year 4. Okay, any questions on this? Are we clear with that? Once you're done with these adjustments, we're going to make our profit statement. Okay, marginal costing profit statement. All right. Yes, and this is our marginal costing profit statement. Right. So since this is for 4 years, so we need to calculate the profit for 4 years. So we begin with sales revenue. Sales revenue is a selling price multiplied by the units sold. In our question here, they told us that production and sales volume is 250,000 units of yogurt, meaning every year this is how many units of yogurt they'll produce and sell. Okay, so for year one, the selling price 10 kwacha multiplied by the units sold 250,000, you get 2,500,000. Year two, selling price 10.9 multiplied by 250 units, 2,725,000. Year three, selling price 11.88 multiplied by units sold 250,000, you get 2,970,000. Year four, 12.95 multiplied by 250,000, you're going to get 3,237,500. Any questions on sales revenue? Okay. Next, we need to tabulate our variable costs. Okay. Because remember, we want to find the contribution, and contribution is sales minus variable costs. Okay, colleagues? Here, our aim is to get contribution, which is sales revenue minus the total variable costs. Okay, so to get our variable cost is our variable cost per unit multiplied by the number of units produced. Variable cost in year one, it's 6 kwacha multiplied by 250,000 units, 1,500,000. Year two, variable cost is 6.6 multiplied by 250,000, 1,650,000. Year three, variable cost 7.26 minus multiplied by 250,000, 1,815,000. Year four, variable cost per unit 7 kwacha 99 ngwe multiplied by units produced 250,000, 1,997,500. Colleagues, any questions so far up to this point? Wonderful, wonderful. All right. Next, we need to get our contribution. All right. So remember, contribution is sales. This is overall contribution. Okay. So sales minus variable cost. All right. So for year one, we're going to say 2,500,000 minus 1,500,000. You're going to get 1 million. Year two, sales revenue 2,725,000 minus 1,650,000. You're going to get 1,075,000. Year three, 2,970,000 minus 1,815,000. We get 1,155,000. Year four, sales revenue 3,237,500 minus 1,997,500. We get 1,240,000. Okay, that is the contribution. Contribution to cover fixed costs. Okay. Okay. After we've got our contribution, now we deduct our fixed costs. Okay, we deduct our fixed costs, all right, to get the profit before tax. Okay, so in our question, the fixed cost is 120,000 per year. 120,000. Okay, so our profit before tax, maybe I'll put it here, is our contribution minus the fixed costs. Okay, so for year one, do it like this: 1 million, which is our contribution, 1 million minus the fixed cost of 120,000, you get 880,000. All right. Year two, the contribution 1,075,000 minus 120,000, get a profit of 955,000. Year three, 1,155,000 minus fixed cost of 120,000, you get 1,035,000. Year four, 1,240,000 minus 120,000, you get 1,120,000. Yes, these are our profits before tax. Any questions? Okay, now we get our profit after tax. Oh, first we get the tax first so that we can get our profit after tax so that we can tabulate that. So the tax rate is 30%. All right, so we're getting 30% of all of these values here. Okay, 30% of 880,000. Yeah, 30% of 880,000, that is 264,000. 30%, so these will come where I'll put these here. Yes, 30% of 955,000, that is 286,500. 30% of 1,035,000, that is, excuse me, 310,500. 30% of 1,120,000, that's 336,000. Yes, sir. Go ahead, sir. Yes, sir. Always being recorded. All right. No, do not worry. Okay. No, do not worry. It's being recorded. And once the recording is done, I'll resend this document also. Bluetooth mode. Okay. Yes. Okay. Okay, you're welcome. Okay. Profit. So once we've got our taxes, we get our profit after tax. All right. So profit after tax is your profit before tax minus the tax. So 880,000 minus 264,000. Oh, okay. Yeah. 616,000. Right. Yeah. Two, profit after tax. Profit before tax 955,000 minus the tax 286,000. You get 668,500. Year three, profit after tax 1,035,000. Profit before tax minus the tax 310,500. You get 724,000. Okay, year four, profit before tax 1,120,000 minus the tax 336,000. You get 784,000. Yes. Okay. Next, we need to add the scrap value for year four. All right. Remember, scrap value, this is how much the machine can be sold for after its useful life. So we're assuming in year four, We're going to sell the machine for 60,000. All right, 60,000. So this is how I'll do it. Oh, let me just also put the charger for my laptop. Just hold on for it 1 minute. Just put the charger. Okay. All right. So here we put scrap value 60,000. Okay. Then make a new row. What's happening? I'm trying to make a new row. Okay, let me just do it like this. Add scrap value. So you're going to say 784,000 plus 60,000. You get 844,000. Let me just see. 784 plus 60,000. 844,000. Yes. Yes. So, colleagues, this was the initial thing that we're looking for. These profits here. These are the ones that are going to undergo the net present value technique and the internal rate of return. Okay, we're going to need to discount these profits here. All right, so I prefer making a new table, okay, because for the sake of the internal rate of return. All right, yeah, so I prefer making a new table like this. Moving discount factor and then present value. Okay, year 0, year 1, year 2, year 3, year 4. Okay. So year 0, this is when you're purchasing the equipment. First day of year 1, say the equipment costed 1.8 million. 1.8 million. Year 1, profit here, we're going to use this 616,000. Year 2, 668,500. Year 3, 724,500. Year 4, 556. Huh? No. 844,000. All right. So our discount factor is at 11%. All right. So let's see, we already tabulated them here. Okay. So here it's going to be 1.11 to the power -0. Year 1, 1.11 to the power -1. Year 2, 1.11 to the power -2. Year 3, 1.11 to the power -3. Year 4, 1.11 to the power -4. Okay, so already got these values. For year 1, for year 0, 1.11 to the power -0 is always 1. Anything to the power 0 is always 1. Year 2, 1.11 to the power -1, we get 0.901. Okay, then 1.11 to the power -2, we get 0.812. (1.11 to the power -3, you get 0.731. Then year 4, 1.114 to the power 1.11 to the power -4, you get 0.659. And colleagues, I hope these figures were counter-checked. Yes. So to get the present value, it's just, oh, here it has to be, this has to be a negative. All right, negative because this is an outflow. Okay. Yes. So basically, our cash flows here multiplied by our discount factors will give us the present values. So -1,800,000 multiplied by 1, -1,800,000. 616,000 multiplied by 0.901, 555,016. For year 2, Yeah, 668,500 multiplied by 0.182, 542,822. Yeah, 724,500 multiplied by 0.731, 529,609.5. 844,000 multiplied by 0.659, you get 556,196. Colleagues, any questions up to this point? Madam Diana, Madam Helen, let's see who, Mr. Boniface. Okay, who else? Um, Madam Karen, Madam Kathy, Madam Liana. Okay, so to get the net present value, you just add these figures. All right. Well, let's see, summation of cash flows minus initial initial amount. Okay. Okay, so here you added first the cash flows to get the total present value, which was 2,183,643 kwacha 50 ngwe. All right, minus 1,800,000. So you got a positive net present value of 383,643.5. Okay, positive net present value. All right, when the net present value is positive, it means you accept the project. Okay, because in simple terms, what it's telling you is what you're making is greater than what you spent. The present value of what you've made is going to be greater than what you spent. Any questions before we go to our favorite technique, colleagues, internal rate of return? I don't know why you didn't reach there. Okay, I was expecting you to reach there. Mr. Kasono, why didn't you reach the IRR part? Okay. Okay. It's understandable. Okay. Except for the increase, meaning there will be an increase of in shareholder wealth. This part, yes, the project will maximize shareholder wealth, but I don't think by this same exact amount. Okay, we'll, we'll put this, but yes. So we've got a positive net present value. Next, we now need to go to part B. We have to use the internal rate of return. All right. So, colleagues, if your first net present value is positive, what happens to the discount rate? Do you increase the discount rate or do you drop the discount rate? Because this part is crucial. You get it wrong, it means you have to redo the question again. Okay, not redo the question again, but you will spend time on making corrections here. Okay. So if your first net present value is positive, what do you need to do to the discount rate? Do you increase it or do you decrease it? Even guessing is allowed, colleagues. You guess, you get the correct answer. Mm, you increase it. Colleagues, remember this trick. I used this trick to always remember. A positive NPV, increase discount rate. Negative NPV, decrease discount rate. Okay, colleagues? If you can use that, it will save you, let's say, on average, it will save you. First, wait, opposite of what? Opposite of what? Mm-hmm. Discount rate. The discount factors are these figures which we're getting. These are 0 point whatevers and whatever. Yes. Colleagues, why are we increasing this discount rate? What is the purpose of increasing this discount rate? Because it's not nice, you just know you have to increase it, but you don't know why you're increasing it. Why are we increasing this discount rate? Mr. Kasono? Mhm. Yes. So that we get a negative NPV. Remember, with the thing, internal rate of return, you need two net present values, one that is positive and one that is negative. Okay. So in the exam, always be extravagant, okay? Don't increase and say, okay, let me try 20%. You try 20%, you find you're still getting a positive NPV. Be extreme so that you don't waste time on thing on this trial and error part here. Okay, so colleagues, this is where I'll need help with your calculators. Okay, so 1.9 to the power negative 1, 1.9 to the power negative 2, 1.9 to the power negative 3, 1.9 to the power negative 4. Okay, the power negative 0, we already have that one. It's always going to be 1. Now to the power negative 1, 0.526. Okay, 1.9 to the power negative 2, 0.277. Okay, 1.9 to the power negative 3, 0.146. 1.9 to the power negative 4, yes. All right. So it's just like a repetition of the same thing what we're doing earlier on. All right. Present value again. It's these discount factors multiplied by the cash flows. Okay. These new discount factors multiplied by the cash flows. So negative 1,800,000 multiplied by 1, you get negative 1,800,000. Excuse me. 616,000 multiplied by 0.526. What do we get? $616,000 multiplied by 0.526. Colleagues, it's not yet 22 hours, so we can't. I hope no one is dozing. You can't be asleep at this time. Huh? Thank you, sir. 668,500 multiplied by 0.277. 724,500 multiplied by 0.146. 844,000 multiplied by 0.0077. Colleagues, these have we counter checked? Because it's only going it prevents me from getting calls at 0102. Okay, I'm the only one who benefits. Okay, I am the only one who benefits. Okay, I do not get the calls at that time. So yes, so we just add up now. Negative 1,800,000 plus 324, 324,016 plus this plus that plus that. Okay. You can do it. Just add all the numbers together, right? Or the other way you can do it is first tabulate the total positive values, then subtract from the negative value. But in this case, where you're dealing with the table, just add the values. Just add all these values together. What about you, madam? What have you found? Tell us your number. Negative 1 million. Uh-huh. point, point six. Okay, okay. Wonderful, colleagues. Yes. Now we go to the interesting part where we have to. Mm, 30, 45. So, 40, so for point 0.5 then here. Yes. So in the exam, colleagues, okay. Okay, but yeah, just leave it to one decimal place, one or two decimal places, all right? Yes. Depending on how much time you have. If time is running out, round off to whole numbers. Okay, just put a note here. Numbers will be rounded off to the nearest whole number. Okay, that will give the marker confidence in you. Okay, so we need to remember these symbols for discount rate. Let's see. There are many ways this formula is shown. Which one does your lecturer use? Does he use the AB, the HL? Which one does he use so that we are not getting confused here? Mention. Wait, someone should mention what? The formula. Okay, okay. No. Yes, who would like to mention? You can pick Mr. Kasono. Pick someone to mention. Okay, colleagues. A is the lower discount rate. B is the higher discount rate. NPVA is the net present value with the um, lower discount rate. NPVB is the net present value with the higher discount rate. Brackets B, the higher discount rate, minus A, the higher discount rate. Okay. What this internal rate of return? Have you seen these cash flows? We're just converting them into a percentage. Okay. That's what the internal rate of return is. Your cash flows in a percentage form. Okay, in an annual percentage form. Is that okay, Mr. Kasono? The IRR is just your cash flows. These cash flows here, year one, year two, converted into a percentage. This is what this is the return your project is generating for you. Is that okay, Mr. Kasono? Madam Kathy? Yes, Is that okay, Madam Kathy? No. Okay. Madam Helen, is that okay? Okay. I just wanted to, so just remember that the internal rate of return is just the return your project is generating you. Okay. Mhm. So just remember, you only need four figures. Okay, these rates here and these net present values here. Just these four things, these four numbers. Okay, colleagues. Mhm. This formula, I think it's given to you. Um, should be given to you in the exam, but you need to confirm that. You need to confirm that. Okay, so that I am not getting calls after the exam. Sir, you told me to the formula is given, so I expected that. Okay, NPV with the lower discount rate, remember it's this 383,643.5. That was the net present value with the 11% discount rate. Then the net present value with the higher discount rate, negative 1,120,044.5. Open brackets aside, 90% minus 11%. Okay, so first things first, 383,643.5 plus, because this is negative and a negative, so plus 1,120,000. Do this step by step. Also, you can do 90 minus 11. That is 90 minus 11, 79 here. Now this one here, 383,643.5 plus this number, what do we get? Let me see if there's how many were in class. Okay, 9 others. Okay, all right. Madam, okay, 1,000,000, 503, 688. Colleagues, wonderful. Yes. I have to make sure everyone is awake. Okay, colleagues. This is financial management. Okay, this is FM. Okay, so 383 divided by 1,000,000. Are we getting 0.255? Colleagues, I'm getting scared here. I'm mm, yeah, yes. So 0.255 multiplied by 79%. Ah, Madam Cat. Yes. Is the font okay? Okay. The 0.255 multiplied by 79. Are we getting 20.145? Okay. Then 20.145 plus 11, 31.145. Okay. So for the internal rate of return, okay, if the IRR is greater than the cost of capital, meaning if the project is generating you more than what it cost you to borrow that money, accept the project. Okay, but if the IRR is less than the cost of capital, meaning the project, what it's generating you, it's less than the cost of financing, then you reject. Okay. So here, the cost of capital, which was given here as the minimum required rate of return. Remember, from the investor side, that's the minimum return they want. From the company side, is the cost of capital. All right. So this is greater than this 31.5% is greater than the 11%. So we accept the project. Okay. It's rare you have a scenario where NPV you accept, then IRR you reject. Because I know someone was about to ask that question. What happens if there's such a case? You rarely have such a case, okay? And if you have such a case,